Hello and welcome to this online roundtable. I'm Mark Dunn, the editor of Portfolio Institutional, and I will be your host for this discussion, which focuses on green bonds. Now, a green bond is a simple concept. Investors lend money to corporates, governments, or banks which use the capital to fund projects that create a positive environmental impact. It is putting people with capital to invest together with those who need capital to make their operations greener or generate cleaner energy or make electric cars. It's a growing market. Indeed, by the end of 2020, $1.1 trillion had been raised from these bonds. But like a lot of things in life, there are issues. The main one being, are the proceeds raised from these bonds actually being used for green purposes? To find out what's happening, we put together a panel of experts. So let's meet them. Henrietta, can we start with you?
Hi, my name is Henrietta Gourlay. I work for a large British family office who has a very strong focus on climate and ESG and sustainable investing.
Okay, thank you very much, Henrietta. Graham.
Hi, Graham Anderson, Chairman at 24 Asset Management, responsible for ESG and sustainable business.
Thank you, Graham. Thank you. And Josh.
Hello, Josh Palmer, lead the sustainability research efforts in fixed income at Willis Towers Watson, and I'm also a member of our Climate and Resilience Hub.
Great, thank you, Josh. Scott.
Hello, yes, my name's Scott Friedman. I work at Newton Investment Management, and I'm portfolio manager and credit analyst on our sustainable fixed income portfolios.
Thank you. Sarah.
Hi, yes, I'm Sarah Mitchell. I'm a portfolio manager on Mondrian's global fixed income team with a focus on credit. We run developed global and local currency emerging market debt strategies, and very recently, last year, we launched a dedicated global green bond fund as well.
Good. Look forward to hearing about that. Thank you, Sarah. And last but not least, Joe.
Hello, I'm Joe Dabrowski. I'm the Deputy Director of Policy at the Pensions and Lifetime Savings Association, looking after lots of areas of policy, but including responsible investment. I am also a member of the Responsible Investment Advisory Group for the local government pension scheme.
Brilliant. Okay, guys, thank you very much for that. Good to have you all on board. Thank you. Henrietta, could we start with you? Are you investing in green bonds?
Not currently. We tend to invest through funds, and I have an underlying issue with making sure that the green bonds are actually investing in green projects. My biggest concern is that, sorry, my daughter's come in. My biggest concern is that the proceeds could be used for other projects, particularly if it's a large multinational company who has other financing requirements. In addition to that, I'm not convinced that the covenants that are put in place on the green bonds are really sufficiently strong enough to make sure they probably are being used. So until that gets resolved, I would be slightly cynical, but I think there are probably ways around it, and collaboration, also private-public collaboration is probably one way, and getting the government to set standards would be another way. So it's an evolving market, but no, currently we're not invested in green bonds.
Okay, thank you very much for that, Henrietta. Sarah, you just mentioned there that you've launched a new green bond fund. Are you hearing what we just heard from Henrietta there? These are the common complaints you're hearing from investors when you sit down with them?
It's certainly a question we're asked, and a question we think we should be asked as well. And that's why we feel very strongly that the green bond segment of fixed income lends itself well to active management. So we apply our existing philosophy and process to think about the value of the bond and positioning in bonds, currencies, sectors. But we have a very important first step, if you like, that does the diligence on the bond to identify, are they truly green bonds? But a lot of the conversations we have with consultants, potential investors, existing clients are obviously it's on a spectrum, so it's going to be inherently there's going to be some subjective judgment in there. So we try and make it as structured a framework as possible. We have a database for all the bonds we're considering, where we look at the quality of the reporting, use of proceeds, impact reporting, who's giving a second opinion on those bonds. And that's something we think there's massive scope for improvement and standardisation, because at the moment you're just trawling through PDFs. Everyone's reporting is different. The quality varies significantly. So we've been talking to people such as Euroclear who are thinking about a solution as to how, in our mind, this is somewhere where there's a big scope for a product or someone to come in and make some money helping out and automating this stage of the process.
Gotcha. Okay. Greg, could we go to you first? You're on the front line. Is this what you're experiencing?
Yeah, I think in a way I agree with both Henrietta and Sarah. I think what's interesting about the green bond market is traditionally, if you get a new market arising, and I still think this is a new market because I think the stats back that up. Yeah. But traditionally in capital markets, when you get something new, it tends to come at a premium for investors, and that market tends to work quite hard at convincing investors that the structures, the controls, the covenants are all appropriate for what they're trying to do. Mm-hmm. And in a way, I think the green bond market's a bit of a victim of its own success at the moment, in that I think there are enough investors out there that want the badge of investing in green bonds that they're just willing to invest in anything that says it's a green bond or a sustainable bond. Consequence of that is that this market is starting the wrong way around, and that's why I think there are all these frustrations at the moment, because there isn't the oversight or the market trying to persuade investors why they should be doing it, and I think that's actually slowing up the development of the green bond market.
Okay, so thank you, Graham. Scott, if we come to you next, the conversations you're having with your potential investors here on the green bond side of things, how tough are they?
Yes, I mean, again, it's the kind of, we're being asked the same questions that we effectively ask of issuers, and the way, and I suppose it comes back to that active approach rather than just buying anything with a label, is that the first place we really start as well is looking at the issuer as a whole, looking at their ESG credentials. We're not going to invest in a green bond of an issuer who actually scores really poorly in terms of the way we score that either sovereign or company. Broadly, they need to. We want senior management buy-in ultimately to that transition, to the projects, to are they a solution provider or are they really transitioning from a harder place? So that, along with more consistency and standardization, will help. But obviously it's that accountability point we really want to try and ultimately that's, I think, what everyone would like to see is and the covenant question is how strong are the covenants in place, but yeah, clearly we will have that ongoing verification, if you like, of the bond proceeds, but it's also just, and I think one way the market can probably develop further is also limiting the look back period in terms of not just refinancing old project debt, but actually it's the additionality point. Really making a difference is what's super important for us.
Okay, thank you. Henrietta, going back to you, from what you've heard so far, has that maybe eased any concerns you might have?
Yes, it does. I mean, the underlying issue is, are there cross default provisions? Because ultimately, if a company gets into financial distress, they will need to get the money from somewhere. And if you've got a bucket of money that has been allocated even to a green project, but it's going to save the company from default, I suspect it would get used to that. But back to Scott's point, as long as the company has got good ESG credentials and is, and is doing its best, then that's what you can go for. But I mean, the other thing to say is that there are lots of regulations, not regulations, but like, for example, in pension regulations, you've got the TCFD now. So that's all about the, the organization's approach to climate and this, that, the other. So you can sort of assess whether a company is genuine, which does give you some, yeah.
Gotcha. Okay, I think it's everywhere. Can we go to Scott just to reply to what you heard just there, and then we'll move on to Joe.
Sorry, I took my hand down from the previous question.
Oh, I see. Okay, gotcha. That's a question ready for everyone. Okay, Joe, what about you? What are you, from your side of the fence? So asset owners, are they interested in green bonds? Maybe are they put off by a few of the issues that Henrietta's raised?
Yeah, I recognise all the issues that have been raised in the discussion so far, and I think it's also, as we know, there's still quite a long way to go across the piece on climate and ESG reporting generally to get us into a place where the measures, the metrics, and the assessment can be done in a much more comparable way. Green bonds are unique in needing that work done too. Asset owners are definitely interested in green bonds. We spoke to our members during the course of last year quite a lot when we looked at appetite and challenges around climate-related investing, and green bonds was something they expressed interest in, and also were very keen that the UK produced a sovereign green bond, and we've obviously had that announcement and waiting for the next steps for the Chancellor to tell us what that's going to look like, and that'll be interesting to see what it looks like, how much he's willing to commit to it too, against general issuance. And I think there are a couple of things probably worth bearing in mind as well. So there's the green bond principles, which are quite helpful in the sense of trying to give a little bit of structure as to some of the questions that kind of Henrietta identified. Is it genuinely doing the thing that it's supposed to do? Is it traceable, trackable, reportable? And is it essentially ring fenced for the purposes that you purchased it for? It's interesting that the EU has more or less lifted and shifted those principles when it's thinking about taxonomy and next stages for its regulatory framework, added a little bit of extra on verification of assessors. So I think we're heading in the right direction. It's still pretty juvenile market. Lots will, there'll be some horror stories to come out, I'm sure. But I think we're heading in the right direction, and definitely the appetite is there to do this. And more generally, the appetite for gilts, certainly amongst mature DB schemes, always outstrips what gets supplied by the market. So there's definitely a client side demand.
Great. Okay, thank you, Joe. Josh, I saw you nodding along there.
Yeah, well, I agree with a lot of things that have been raised within this conversation so far. We too invest through underlying managers. So a key part of our research is understanding how the asset managers are understanding the use of proceeds of these bonds, how these bonds might perform going forward in any sort of default scenario, how the use of proceeds might get allocated. And this is just a source of competitive advantage, we believe, for asset managers going forward. And those that really can understand the green bond market and how they might perform going forward will be leaders going forward. And it's just an extra lens we look at our portfolios through.
Great news. Okay, thank you, Josh. Okay, guys, we've covered quite a lot of points there, and I'm sure a lot of them will be brought up again as the conversation progresses. Just to get back to the beginning here a little bit, Graham, are green bonds actually making an impact on climate or fighting climate change? We do governments, corporates, banks that are all setting these targets to be net zero by a certain date, whether that's 2050, 2030. From your experience, is it working?
Well, it's working in the sense that it's, I think, providing a focus for companies. So that is a good thing. And I would say that, I did mention that this market is starting the opposite way around from a normal market. The good news is that the reason that the market is starting the wrong way around is because there is so much demand and so much interest from capital markets. Yes. So I think that is a good thing. Capital markets are responding to the challenge. But I think that investment banks, origination teams all over the globe are looking at all of their clients, i.e. companies, for anything they can attach a green bond to. So we'll have to deal with that. And I agree that active management is the best way to do that. I think in the whole ESG world, box ticking is very dangerous. I think you get some consequences that you didn't expect for clients, which is not good. But yeah, I think we should be positive about this.
Okay, fine. Henrietta.
Yeah, I was just going to say that I think that they should really help climate change, because part of the problem with addressing climate change is the cost of actually producing the equipment, or or improving your manufacturing process or whatever.
Yeah.
So people need access. The companies need access to capital, and it is definitely providing that. And I think it could have a particularly big impact in emerging economies, and say Middle Asia, where most of the climate's the carbon footprint is coming from anyway. So I think as long as it's managed, they definitely should be helping, but maybe not there with the scale of it yet.
Okay, thank you, Henrietta. Joe?
I was going to agree with what Henrietta said. I think, we're not in a place yet where we can say the financing is flowing through in such a way that you can demonstrate a measurable impact. I think we're probably some way off of that, but definitely the financing is coming through, and definitely you can see that going towards more projects. Obviously, that will need to become more precise and measurable and accurate in future. If you think about the kind of wider landscape, reporting from companies, in due course, listed companies here in the UK, premium listed ones at least, when they start to kind of report on TCFD and other elements, those metrics will begin to flow up, and then there'll be a way to kind of tangibly say there's a financing going here, and we'll get the kind of holistic picture which will tell us what's going to where and how that's being impactful. Couple of years away, I think, but we're definitely heading in the right direction, and as Henrietta said, the flows of capital are going towards the right places on the whole.
Thank you. Scott?
Yeah, I would just add that clearly there might be some really interesting green projects out there that an issuer has to offer, but if they're not large enough to parcel up into a liquid bond, then that isn't the fault of the issuer as well. So it's, I suppose to an extent, it can skew towards some best in class, because maybe some of the issuers of green bonds are already very far along the journey in terms of renewables, for example. You have a big piece in the middle, I suppose, where it is about that really determining how green the projects are, and then obviously drilling down deeper into that. But I think at least what it is doing, it's focusing companies at least to try and think about the future, and maybe they can ultimately go down that avenue. Obviously, the other side of it is just the standardization and how investors look at that. But at least it does help focus, I think, all stakeholders, and that's really what ultimately is we're on the road to achieving more of.
Gotcha. Thank you. Sarah, another criticism of the green bond market is that there's a lack of diversity in terms of the issuers, and these issuers are typically on the cleaner side of the spectrum here. And what do you think is needed to get some of the more heavily polluting industries to start issuing green bonds to fund green products, maybe clean up their operations?
I do think we are seeing some of the less green industries coming to issue now. Obviously not at the kind of oil and gas end of the spectrum so much, but for example, in the second half of last year, a number of auto makers came to the green bond market, and whilst they're in traditionally, I guess, unclimate friendly sectors, the green bonds work quite well for them, we believe, because you can point very clearly and ring fence very clearly they're funding their electrification efforts. So we're already starting to see some measure of diversity away from your traditionally more climate friendly sectors into the green bond market, but it's very early days. As Graham said, this is it's still a very new market. I do think market forces will have a big part to play. So ESG, as we all know, is becoming increasingly important and a bigger part of the conversation with everyone we have as investors. So issuing a green bond and using green bonds as a tool to think about those environmentally beneficial projects will be looked favourably upon by investors, not just fixed income investors. And there's also the benefit of diversification of your investor base. So as these issuers in less climate friendly or higher emitting sectors are getting pressure from plans that are maybe divesting oil and gas, there's the EU thinking about bringing environmental factors or green asset weightings into their calculations of capital. So they'll be getting pressure on more traditional sources of funding. So those with dynamic management teams and looking to the future and how they transition, green bonds are quite a neat, I I guess, vehicle and solution out there that also bring benefits. And we want to invest in green bonds, funding projects that will get you the most bang for your buck, really. So they often won't come out of green sectors, which are already doing great things. So as long as we're careful and really analyse the ESG credentials of the issuer, and are those bonds really funding green projects, you can often get the biggest impact going into those non-green sectors or issuers from emerging markets, for example. So it's all moving in the right direction, we believe, and the market forces are there to help, but it is very early days.
Thank you, Sarah. Scott?
Yeah, I suppose just to add on to that point, we're already seeing more diversification as the green bond market matures into different sectors and different geographies, which is really good. But just point to that real transition piece for, I think, is really the most powerful. It's about mainstream capital rather than just green capital. It's really society will benefit the most from really transitioning those harder to abate sectors, if you like, to greener. And maybe it will be a part of this conversation as well, but it's I think what the green bond framework has done is really set a precedent for other innovations in ESG labeled bonds. And it's those really hard to transition sectors, such as oil and gas, that might go down the sustainability linked bond route, for example. So other innovations where you've got kind of accountability there. But I suppose it is always this debate: should a whole sector be demonized or not for where it is today? Or actually, it is going to be a very energy intensive transition that's required. So it's about really, I suppose, it's about broad stakeholder appreciation and engagement, and really trying to kind of, I suppose, appreciate where we're at and the challenge we face, rather than actually saying, but I suppose that's where also frameworks can help issuers and investors at least be able to, I suppose, scale these types of instruments and in a credible way most speedily.
Thank you. Thank you, Scott. Joe, asset owners, are they interested maybe in more of the sort of heavy polluting industries and trying to get their money in there and try to clean up? Because obviously the idea here is to transition to a low carbon economy. You're not going to do that without actually targeting the big polluters.
So I think they will look reasonably favourably at those who seem to be committed to transition and are walking the walk. I think with a pretty sceptical eye on those who appear to be moving to try and get some finance, but aren't really engaging properly in any form of transition or move to markets. I think, as Scott said, what we'll probably see is quite a lot of mainstreaming of some of this in the next few years. And I think then you'll see the kind of capital move. There's some important things, I think, for asset owners that they'll be needing to consider. What are the credentials of the issuer? How do you verify that? How do you verify the use of the bond for investable opportunities? There'll be a hearts and minds piece from those issuers who may be of either grey or even murkier reputation for how they are moving forward, and sectors that maybe look more challenging, like oil and gas. There's going to be a pretty hard sell needed, but people will, where there's a transition and there's definitely a very heavy green tinge, people will be comfortable. Where's what's being described as sort of an olive tinge, I think fine. And then moving on. I mean, I think one of the big questions will be, will we still be talking about green bonds in 5 years' time? Will it just be bonds because the direction of some of the other forms of regulatory travel are making it very difficult to finance things that are not aligned with trying to achieve the Paris targets? I suspect there will be a more than a 5-year transition, but that's the direction of travel, and therefore I think we will see this become less niche and more mainstream, as we have with responsible investment more generally over the last 5 to 10 years. We're on that journey with this type of instrument as well, I think.
Gotcha. Thank you, Joe. Graham.
I think just to add to Joe's point, I mean, my experience is that asset owners are still quite keen to screen out sectors at the moment. I think that's a debate that needs to be had, and I think people around this table are kind of there with, like, you need to be active, you need to think about transition, and screening has its place, but I think screening can get in the way of that transition. I think that's what some people are saying, and I would just say that I think, my experience so far is that quite a lot of asset owners are just thinking they're doing the right thing by screening sectors, and I think a little bit more engagement with an active asset manager to understand what can be done would be valuable. But again, I think that's just part of the journey. But I think that needs to be said.
Gotcha. Thank you. And Josh, in your research, are you seeing a willingness from investors to target more sort of heavy polluting industries?
Yeah, so we have some exclusions that we're looking to put in place, and we think that makes sense in certain mandates. But I think the key tool here is engagement as we move our portfolios towards a more 1.5 degree type portfolio. We believe that it's important that managers are able to find companies that are on that pathway and have science-based targets. And they might not necessarily be green issuers, but we think those companies are there. And we're also moving more towards more positive selection type strategies. So particularly in areas where there's concentrated risk, like US high yield, for example, we believe we can find companies that are ahead of the transition, looking at investing in low carbon technologies and are good at deploying that sort of thinking into their business strategy. And we think these will be leaders going forward, and there'll be step downs in coupon yields for investors for those companies as well.
Okay, we'll sure get to that point soon, definitely. Henrietta, did you want to come in there?
This was just more to sort of Joe and Graham's point, actually, but because there is a potential can of worms with green bonds, which is if you take something like electric cars, well, they need lithium and copper, and you need to get that copper and the lithium from somewhere. So therefore, can a lithium mine issue a green bond to produce its lithium more, better or more efficiently, or just produce it? And if you are screening out, then you're obviously not allowing that part of the market to access that capital, which means that they'll probably continue doing it in an inefficient way. But it's an argument to be had, and there isn't a right or wrong answer, but it is just one of the quandaries that we face as investors.
Gotcha. Okay, thank you. Sorry, Graham, you've got your hand up. Is it another point you want to make on this?
Sorry, I didn't realise I had my hand up. So, but yeah, I agree with that. I think the whole, the whole ESG market is full of dichotomies between, as a company transitioning, as a company to be supported because it could be in a screen sector, and again, I think bit of a broken record, but I think you have to be active management to think about these things. Oxygen gives you confused results. But ultimately, I think Henrietta's right. We will not always be making decisions that are 100% feeling good. It's impossible. And I think asset owners, asset managers, we have to understand sometimes that is the only way you're going to make progress. Sometimes just to take some views.
Okay. But thank you, Graham. Can we move on now to another issue which could help develop the green bond market? The British government has announced that it intends to join and it intends to issue its first green gilts. Sarah, do you think that will encourage greater corporate issuance? Where the government go, the corporates follow?
Yes, I think so. Historically, we've seen a sovereign green issuance galvanise the corporate market. It provides a safe asset, and obviously they've got the ability to issue in much bigger size than your corporate issuers, so it immediately provides more scale. Obviously the way they do it is important, so benchmark size across the curve if possible, all things that will help grow the corporate market. But I mean, on its own, great, it helps, but I'd argue probably more importantly is they need to be doing stuff, and this has come up in other people's comments at the kind of at the policy level, to create those green projects that then need the capital from the corporate market. So issuing a green bond on its own, great, it helps, but it needs to be part of a wider agenda, which I know there are noises about at the current point in time.
Thank you, Sarah. Scott, sorry, you've left your microphone on.
Thank you. Sorry. clearly a very current issue. Some of the fixed income collaboration work I do. So I sit on the Investment Association's working group on looking at the structure of the forthcoming green gilt. So I think it's a real opportunity for the UK to try and be leading in terms of its thinking about where do green bonds go next. And it's not going to be a social bond or combined sustainability bond, but there are expected to be social co-benefits. And it's about how actually not just looking at the green element, but ultimately what kind of green jobs do you create, what other social positive impacts can there be that can also be reported on. So again, it's the accountability point. We're reporting on not just the green benefits, but maybe some of the social co-benefits. And I think it's really important trying to, again, look at this additionality point, limit that look back period. Don't just refinance 1, 2, 3-year-old projects. And actually having a very robust mechanism in place, for example, an audit committee to actually really vet the projects on the way in, but actually monitoring those. And I think it really does, if you can come up with really good and clear, often quite concise as well, frameworks for reporting, it really does give the private sector that, the scalability. So, right, okay, this is being used by the government. It makes complete sense for us to launch our corporate green bonds aligned with this framework. And therefore, all investors should be very comfortable with that, and just enables the scaling up domestically. So often we've seen, as a sovereign issues green or ESG labeled bonds, that the private sector follows suit quite quickly. And I think in the US, and maybe we'll get there at some point as well.
Thank you. Graham, this is good news, sure. Good news for the development of this market.
I'll probably take a slightly different view from the panel here.
Okay.
I'm slightly, well, one, I don't think that the private sector needs the government necessarily to lead the way. I think the private sector is very capable of doing that on its own. Secondly, my view is that governments are voted in by society to do the best thing for that society, and they shouldn't need some sort of green premium to do that. I think that's a ridiculous notion. So I can see the need for government green bonds in maybe emerging markets. I think Henrietta mentioned that earlier. But in terms of G7, I think for governments to try and get some sort of like lower funding costs for green bonds is a bit of a nonsense, really. I think they should be doing that anyway because that's why they're voted in. And I think that also causes other problems, because if you look at the global green bond index, the yield to investors on that's pretty low. And part of the reason why it's pretty low is that more than half of the global bond green index consists of government issuance. And that, I would argue, partially crowds out the private sector. So I don't think this is as clear cut as maybe some other people think. And actually, the amount of corporate green bonds is, I think, less than 4% of the global green bond index. So for me, we should be focusing on corporate issuance, maybe some emerging market government issuance, but yeah, I'm just taking a little bit of a different view on G7 government green bonds.
Okay. Joe, where do you think the focus should be? I mean, Graham just talked about the emerging markets.
Yeah, I mean, I think there'll definitely be a need for emerging markets, and I think, when you look at take a slightly broader picture than just green bonds for the climate transition. Emerging markets are a key area that will need financing in order to lift people out of poverty and to address the wider impacts of climate there. So it's a natural flow for green bonds as well to be in those markets and be in those less mature financial systems too, as Graham has pointed out. I think if we look closer to home, though, there's still quite a lot of work to be done on the financing. I think it's an interesting philosophical question as to where that comes from. We obviously seeing a lot of green bond issuance from the EU. It seems like the real politic of the government hosting COP. It was always likely that they would issue or seek to issue a green bond in order to demonstrate forms of leadership, whether you view that as helpful or just simply playing politics. That we've got to a point where it's probably quite useful for them to have done it, certainly in the eyes of our members. I think we are also at the point, I think, of possibly a really big transition over the next 20 to 30 years in all sorts of sectors, and I think quite often that's been driven historically by large government intervention as well as corporates building on the back of it. We think about past industrial revolutions; those have often happened in that way. So I think there's. So I think it's helpful. I think there's a lot that needs financing in the UK and Europe as well as in emerging markets. I think we do need to get to this question of how do you get solve the question of the greenium, and we might talk about that later. And also, how do you encourage, how does government not crowd out corporates coming into this space and creating that kind of vibrant market? I think when I look at the demand side is really quite high, and the issuance, I think, will still probably be quite low from the UK government. I don't think there's a big appetite to issue lots more gilts. They've not really wanted to do that for CPI gilts in the past. They've kind of kept the RPI levels, index levels, pretty static for some while. So I suspect they'll come in, there'll be some noise, it will be substantial, but it won't be big enough to crowd out everybody else. There's probably more of a risk of that from the EU, I'd say.
Okay, Joe. Thank you, Joe. Henrietta, we're coming out of a pandemic. We hope we're coming out of it, and economies, including the UK economy, has been hit pretty badly. And we have the political slogans like "Build Back Better," and we've got "Build Back Greener." Do you think that green bonds will be taking a big role in here when it comes to sort of fixing the economy and driving it forward?
Yeah, I mean, as I said, it's a way of financing, isn't it? It provides an additional tool which will give financing to companies. And there will be demand, I think, because there's a lot of, as I mentioned, the regulatory change. But, in Europe, you've got the SFDR, and I think there's going to be a lot of pressure on investors to be looking for green investments. So I think that there's going to be a supply-demand balance. So hopefully it will help the recovery.
Gotcha. Thank you, Henrietta. Sarah, the recovery, is this going to lead to an increase in green issuance?
Again, it comes back to the individual governments and the way they're thinking about I mean, there's obviously a massive amount of stimulus spending, and there's an opportunity there to divert some of it to environmental spending. As you're seeing, the EU is probably the most topical and biggest example. So it is happening to various degrees. Obviously, the US with the change of administration, they'll probably get something through. So there are funds being diverted to these projects, and green bonds are one way that these can be financed, but they do tend to lend themselves fairly well to the type of projects that kind of infrastructure spending, like these big ticket government projects. So there's definitely a role to play for green bonds, and the more the better. Especially if it spurs these projects, which can then lead to greater issuance from across sectors, so leading to that diversification away from sovereign and government-related issuers. There's more projects there for the corporates to fund. So I really think there's definitely a role to play for green bonds. It's an opportunity.
Okay, great. Thank you, Sarah. Joe.
Yeah, I'd agree with what's been said. I think it's just worth noting, I think the EU's, or the bank rather, has committed to 30% of the bonds issuance being directed towards coronavirus recovery funds. So I think, that's a substantial impact. I think we may see something similar here. Some of it, I think, comes back to some of the earlier points about being careful as to what purpose some of this being used for. It feels that maybe some of the elements of the coronavirus recovery might be better in a social bond or other format rather than green, and we have to be a little bit careful that everything doesn't get lumped back into sort of a Build Back Better label and move forward. But I think I would imagine some financing will come through this route in order to help with the recovery. And there are ways of doing that make it work in this space too.
Thank you. Scott.
Yeah, I just made the point. I think the kind of investment banks, for example, have quite an important role to play in the middle, because obviously they're going to their clients who are the companies, and we've got to be very careful about this labelling side, because if they see it as a real opportunity to, you know, enhance their relationship with companies or get them along labelled bond route, it ultimately just comes out to the point: make sure they're proper projects that is credibly done, rather than just trying to, you know, play this methodology, if you like. And I just but not to say that's happening, but I'm just going to be very careful at that point, that obviously make sure that it is just credibly done, and that will help, I suppose, the reputational risk and grow the market properly. But also just the crowding out point that was made before. Yes, obviously the sovereigns have issued a lot of this debt, but and certainly for us in the kind of our sustainable portfolios, we don't necessarily just focus on the green bond index in terms of, so I suppose those who do focus on the green bond index, clearly it's a big portion of that. But ultimately, there's a lot more to choose from now in terms of idea generation in kind of green bond issuance, and it is becoming more prevalent in different sectors, and we are seeing more moving into sub-investment grade. So I think the opportunity set is actually improving. I think there will be a lot more supply. The greenium point is always a question. Demand is big, but I think there's a lot of supply coming as well. So it's always that trade-off. But it's certainly something that exists today, but I think it's going to be very interesting to see how that pans out.
Gotcha, thank you. And Henrietta, I saw you nodding away there.
No, it was actually, I mean, I was about to make a similar comment to Scott, in that I think it's really important that we do have some top-down guidance from government in terms of policy and use of the way proceeds are used, because particularly if it's used in infrastructure, you do want to make sure that, you know, they're going to be putting in proper standards and not just doing something more, greenwashing it, for want of a better word. And I believe that the IFC put in a load of, they've got something called the Edge, which is puts in building standards in emerging economies when they're doing building projects there, which does sets the standards high and stops people building in the wrong places, but which will help in the future. I mean, yeah, because you've got to look long term for this.
You have. So thank you very much, Henrietta. And it's an interesting point there. You talk about long-term market. Could we talk about the more sort of engagement side of things, actually, when you own a bond and working with issuers? Sarah, do you think green bonds improve issuer engagement with bondholders? Because this is something that's traditionally always put in the equity side of things.
That's been our experience. Yes, we've had better response to our engagement requests, and just generally better dialogue when it's been sort of green bond specific. It's just given bondholders an extra tool, I guess, and more information than we've ever had before, specific to that debt issuance, to I guess start the dialogue, and also to hold issuers to account as well. We've got some specific targets and these bits of the framework they were meant to be funding, and impact statistics. So we found it's really helped. Also, we've focused quite a lot on pre-launching a fund on engagement with non-issuers of green bonds, just to really understand why the growth of the market, reasons why people weren't issuing. And even on that side, we were able to have, I would say, much better response rates. We look at kind of response rates to our engagement requests than on non-green. Obviously, it's hard to disentangle this between the general shift to more engagement on ESG in general, so that there will have been some in that as well. But we've definitely noticed it's given us a good tool for engagement. We think it's really helped.
Okay, so it's a good tool to really help. I mean, how are you going to build on this? How should we be building on this as an industry?
Again, it comes back in my mind to how we kind of common standards, how you think about common standards of impact reporting as well. We had an interesting conversation with Euroclear, thinking about there's all these projects and potential in emerging markets, and that would really bring diversification to the opportunity set as well, and give us these high impact projects. But often they're small enough, or the reporting burden's very onerous, impact reporting is onerous. And they were thinking about and building kind of test models of ways that they could create a framework within Euroclear, which obviously many of these bonds trade through, to help them access the pool of investors interested in green bonds, for an issuer that might only have enough projects to issue one green bond and put all this resource into it. So I think it all ties together with standardization pre and post issuance requirements, and then that gives you kind of a better benchmark for engagement and to hold investors to account. Issuers to account, and look at how these proceeds are being used, and yeah, that's how we see it kind of developing, or at least hope it will.
Yeah, it's quite interesting you mentioned there about the reporting there on impact, and reporting make sure that the proceeds are used in the way that they said they were going to be used, and because it's making the desired effect. One of the issues I keep hearing from investors is the sort of the governance burden, what you just mentioned there. I mean, how can we make that easier? How can we not only that but also cut costs to this as well? Because this is quite important.
Yeah, it's very important. It's something we're looking at. We obviously want to make it as efficient as possible, but we don't want to lose any of the important detail that's coming from each green bond issuer. And again, I think there's a gap in the market here for some kind of service provider to come in and provide a product. I mean, again, you want the proliferation of ESG service providers, so you want it to be fit for purpose, and you don't want a scoring mechanism or anything, but it's more just bringing that data together in a standardized fashion, because at the moment everyone is building their own databases, and that's fine, but it's not particularly time and cost efficient. But at the moment it's necessary to make sure we're investing in true green bonds, and there's nothing greenwashed in our opportunity set.
Okay. Sounds like there's a gap in the market there. We'll keep an eye on that and see what happens there. Thank you. Scott.
Yeah, just add our experience, and obviously to Sarah's points as well. Just I think certainly engagement for us is hugely important with all areas within fixed income, and including sovereigns as well. But I think when an issuer launches a green bond, I think just there's more alignment there in terms of willingness to talk. Clearly they have a story to tell as well, so that they're more open to that dialogue. But what we do is we use that as an opportunity to ask other questions. So I get back to that point about the issuer as a whole, not just the projects. So we then basically go, obviously it's just a good opportunity. You're speaking to either Treasury, CFO, CEO, but actually just to really broaden out the questions. And I still say today, although there's a lot of talk out there, there's a lot of meetings we're in where peers aren't really asking that many ESG questions generally to issuers. I think there's a lot more that fixed income investors should be really capitalizing on. And I think, okay, we're not a shareholder, but absolutely we can engage. We've got some good engagement examples, and also on the reporting side and frameworks, I think it's quite interesting that the SASP, so we're looking at obviously different taxonomies for what are material risks within different sectors. That's one of the inputs into our taxonomy we use at Newton, but they've now joined together with the GRI. So having these two bodies, quite powerful, working together, it basically is trying to align different taxonomy material risks, but how that should translate into recommended reporting and disclosures for companies. Okay. So now that you have some big bodies working together, hopefully we can begin to get some assistance, I suppose, that will really help that reporting element.
Thank you. Joe.
Thank you. I was just going to sort of dwell on the point of reporting and just maybe from an asset owner perspective. There's a lot happening and there's a lot changing. And if you're an end asset owner, there's quite a lot changing through the chain that you have to kind of keep an eye on, whether it's for yourself, for your reporting, whether it's the change in how your intermediary or end manager is going to be reporting. And I think it would be really helpful for us to always bear in mind that certainly in the UK, we've got quite a spread of schemes. So I imagine from Sarah's perspective that the people that she's seeing the most engagement with and where we see the most engagement actively, directly from the funds themselves is at the very large end of the market. And then when you get down the market, even to the middle of the kind of £1 billion schemes and then below, you begin to see less direct engagement and more engagement through consultants, proxies, and others. And I think to make it really work, finding a way to make it accessible through that kind of pyramid of schemes will be really important, because a lot of time is also being crowded out adjusting to some of the regulatory changes and getting up to speed on those. We're all pulling in the right direction, but there's a lot of them happening at once. And being able to make it as easy as possible for people to access and think about things is going to be really important to making a success of some of this.
Thank you, Joe. Thank you. Josh, reporting is all very big, of course, but going back to the beginning, when it comes to actual terms of the loan agreement, a lot of people tell me that as a bondholder, that's where you need to do your engagement. So are you seeing performance-related terms written into the terms here?
Yeah, we're seeing the emergence of KPI-linked debt and sustainability-linked bonds, which I think is a real good step in the right direction. I think the main difference here is that they're not kind of ring-fence use of proceeds. They can be used more generally, which is really positive, I think, because we can start engaging on broader ESG issues as well, such as social and governance things as well. So, you know, we've seen not only carbon reduction terms written into bond linkages, but also board diversity and, you know, lots of other social and workers' rights issues being linked with various KPIs into bond performance. And I think this is just a signal that investors are starting to recognize kind of the value of ESG within companies and company strategy, and that transition of that into performance and returns, which is actually really positive, I think. And that's what's going to drive the transition going forward.
Great. Thank you, Josh. Graham, is Josh right? Is this a rising trend?
Yeah, I think I agree with that, and also I agree with a lot of the other panelists in terms of, you know, engagement isn't just for equity investors. I think as fixed income investors, we're finding that we can engage very successfully. You know, companies financing is generally a repeated game, so they have to come back to us. They have to listen to what we've got to say, and we are engaging a lot on sustainability. One thing I just thought I'd maybe add to the panel is that at 24 we're a very large investor in European asset-backed sector, and we engage a lot in terms of, you know, the structure of new deals, whether it be CLOs or any other mainstream asset-backed securities. And in that engagement, we're pushing very hard, and I would say reasonably successfully, to make those asset backs or those CLOs more green, more sustainable, better ESG score. And I just thought I'd mention that because that's a market that maybe you don't think about when you're thinking about corporate bonds. You're just thinking, you know, companies, but actually there's loans and underneath all those that you can influence. And even in that sector, we're finding that we can have quite a bit of success.
Okay. So thank you very much there, Graham. Thank you. Time is pressing. Let's get on with this now. So into the final few questions here. It's been mentioned during this conversation about regulation, especially from the EU. I believe the EU are going to be introducing some new standards of deciding exactly what a green bond should be. Do you think this will remove any concerns that investors have over greenwashing? Is this a silver bullet? Would anybody like to come in there with that one?
I'll try.
Okay, Joe.
I think it will help a little bit. I think there's still some way to go on the regulation, the taxonomy, and the remainder. But I think more broadly, the direction is set that it is going to become harder to greenwash products. I think there's probably a couple of other things that's worth bearing in mind more generally. As asset owners have more legislative responsibilities to report on what they're doing to their savers, to their regulators, and to government, the way that they will think about these things will become slightly different and much more eagle-eyed, shall we say? And I think that poses a real risk to people who might wish to persist with greenwashing, because reputationally it will be incredibly damaging to have been revealed to have sold a product that is not doing what it says on the tin. There will undoubtedly, I think, as we talked about earlier, be quite a buoyant and competitive market amongst other providers, and I'm sure they'd be very willing to point out the flaws of their competitors should that occur. So I think there's quite a lot of things that are moving in a way that is going to make this really, really awkward and difficult for anybody to continue with. I think we're probably still in a little bit of a period where there may be an extent to gold rush, and we'll need to work through that, and people will need to be careful, as we kind of talked a bit about earlier in the discussion. Certainly at the smaller end, where there might not be as much expertise or access to expertise, and it would be easy to potentially buy something thinking you're doing the right thing and find out later that it was a mistake because you rushed into it. But I think it's, as I said, direction is set. I think it's going to be really quite difficult and problematic for people to do it in the future.
Good. Thank you, Joe. And Graham?
Yeah, I mean, I think to your question, Mark, about, you know, will some rules from the EU around this be beneficial? I think we can maybe look at SFDR that came out in March as an example of how that might work, in the sense that, you know, SFDR rules are reasonably flexible in a good way, because they understand that there's no one solution. So that's been a good thing. And there's no question in my mind that some investors are slightly gaming the SFDR system already.
Okay.
But overall, and this is the most important thing, overall, what those regulations do is it again ups everybody's focus on ESG, on sustainability, on green bonds, and you know that just raises the whole tide. So for me, I think you can always pick holes in something, but in general, I think those rules have definitely upped everybody's focus yet again. So therefore, I think if the EU comes out with some regulation standards for green bond issuance, I would anticipate that it'll do the same. It will take us another step forward on that journey. So I think we should be positive potentially about that.
Oh, good. Thank you, Graham. Scott?
Yeah, just on the EU proposed green bond standard, clearly they've done a lot of work on the taxonomy, which I think is, again, really powerful in terms of what it's trying to achieve, but also do no significant harm. And I suppose the EU green bond standards mean that a green bond will be taxonomy compliant. But it is this debate around the taxonomy and how kind of specific it is, I suppose, as a starting point today. I don't think we're getting as much maybe of the transition piece in there that maybe would be good to have. And obviously we've got to be careful about investors, issuers playing methodologies, just trading methodologies. But I think, I mean, that's why I think it's been a bit confusing, certainly to start with the taxonomy, because there will be revisions to it. And they'll probably grandfather existing green bonds that it still can be eligible, even though the taxonomy terms and what's included and excluded can slightly change. But it's all going, again, to the point, it is actually all going in a positive direction, but it's just the consistency is quite tough. And I suppose it has to be done, you know, credibly, but it's about not being too specific. And it comes back down to the greenium point as well. If you're just taking taxonomy compliant issues or issuers in a very small subset of the universe, then basically it's going to be a real land grab, and then investors want to say, look, oh, we've got a completely taxonomy compliant product here for you, where things can just get overly expensive from an investment perspective. So it is, I know it's a challenge, and it's not an easy one to solve, but I think we would prefer ultimately the taxonomy to be more broad in terms of what it's trying to bring in. We might get there in time.
Okay, thank you. Joe?
Thanks. Just one point where Scott was articulating this point kind of came to me, that we talked a lot about the EU, US, China. US is playing catch up pretty fast after 4 years of Trump. But we have to see where we kind of land globally as well. We might see some good progress based around the discussions for COP. But it's also a case that investors might either be able to shop around, or there might be differences in global standards for a little bit. So what we have locally on our doorstep, and how the taxonomy in Europe influences the taxonomy we might have in the UK. There's still quite a lot of opportunities for friction and difference. So some of that still needs to be kind of overcome longer term.
Okay, thank you, Joe. Henrietta, does all this regulation, or talk about regulation, is this in any way sort of easing any concerns you might have over greenwashing if when you do decide to add some green bonds to your portfolio?
Yeah, I think it is, but it's not there yet.
Okay.
I think the other thing that's important to point out is that pension funds are pretty visible, so you can see their approach online. So the TCFD, for example, so it's all out there. So there is another incentive from the buyer's side to make sure that they're doing good as well. So, but I mean, we're not there yet, but I think certainly we're getting closer.
Good, great. And Josh, just bringing you in here in terms of your research, do you think this research regulation is adequate? Is it needed?
Yeah, I think greater disclosure and transparency is definitely needed. But I think with regulation, it only works up to a point. And what really matters is getting under the skin of the company. So what is their strategy for dealing with various ESG issues, including the green transition? And what's their commitment to it, and what actions have they actually taken moving towards that goal? I think nothing is going to get past having actual engagement dialogue with companies to really understand what their thinking is with regard to this stuff, and that is what's going to solve the greenwashing issue, not just regulation, in my opinion.
Okay. Thank you, Josh. Thank you. Moving on now. I mean, green bonds is a specifically labelled debt. Obviously, we talked about it's got a specific purpose, but this sort of market is evolving, and it's not just about green label bonds anymore. There's other things coming in. I've read about blue bonds, ocean bonds, sustainable bonds. I mean, what's the demand for this type of labelled debt like? Scott, give us any insight into that.
Yeah, sure. I mean, yeah, so sustainability linked bonds, the first issue was, I think, end of 2020. So again, not long ago. I think we'll probably see at least $100 billion issued this year in that alone. So that's quite, so I think the fact that precedents are there in terms of some frameworks, and there are more frameworks, again, for sustainability linked bonds now, there's also a framework being put out there. I think it does help the speed to market of new innovations. I think it's bad to have too many of these innovations because, again, it's just more complexity. I don't know what we need now that we haven't already got. I think ultimately we've got use of proceeds bonds we've been talking about today, which is obviously green, but then you have the social side and maybe blue. But I think the sustainability linked bond is the other part of it, which ultimately is where you don't have those projects that are eligible, but actually you have a key performance indicator set for the issuer as a whole. So we haven't had any sovereign ones yet, but maybe we will in time. Yeah. But and I think that's quite powerful because you get senior buy-in in terms of management teams of companies, for example, and there is reputational risk on the line in terms of meeting those certain criteria by certain dates. Otherwise, there is a penalty. You can argue is the penalty enough in terms of the coupon step up. You can actually step down in loans, but only up in bonds. And yeah, ultimately, is it done in a way that the targets are stretching enough? But what that does, it just really, as I've talked a few times already about, it's just the mainstream element, mainstream capital and the transition piece that really enables, also from an investor perspective, much more diversification across different sectors. We're already seeing in the sub-investment grade quite a few issues now going down the sustainability linked bond route. Again, concerned about that greenwashing, whatever washing side of it. So again, do your in-depth work on that. And we have seen some gaming around covenants already in US high yield. That mean that those covenants that are set in that sustainability linked bond don't actually come in until too late a date, where other covenants, for example, call structure can come in. So that didn't work. So we're already seeing some issues around that. I think that should be ironed out. And again, it's about being done credibly to be able to scale up. But I think having senior management buy-in, I think is really powerful in terms of what this is trying to achieve. How governments go down this route, I think, is going to be quite testing, because you've got to get governments willing to commit to certain KPIs, and then what happens when you have a change of government. But I think it does really, I mean, I'm quite optimistic about it. Again, it's about hoping that it's done in a proper way. And again, I've already would point to the fact that we need people in the middle, the banks who are speaking to the issuers, to again make sure that the work they do around that is upholding what is really the main aim of these types of bonds.
Gotcha. Thank you, Scott. And Sarah, all these additional bonds that are coming along in the labelled debt market, are they needed?
I guess our view is that I echo Scott. We don't want too much fragmentation of the market for it to, I guess, reduce risks of greenwashing or whatever that aim of that bond is trying to achieve. The more different types of instruments there are, the more different standards, it just muddies the water and makes that overall assessment more difficult. There's definitely a place for different structures. Echo the thoughts on sustainability linked bonds. It's a nice route to market for companies that might not have the scale or the number of projects to issue a specific use of proceeds bond, but these can be brought under the same umbrella. Too much proliferation in our view. We'd like for the market to grow, achieve diversification and scale. We want as little fragmentation as possible. If their aims are all environmental, for example, or obviously there's social as well, kind of how many different types of instruments do you need? Can they not be brought under a common umbrella?
Sarah, thank you very much for that. Has anybody else got a point to make on the sort of the wider sustainable market? Josh?
I just think one of the biggest challenges that investors have is demonstrating performance on ESG metrics and how that relates to performance as well. And I think this is a great step towards that. If you can see carbon emissions coming down while you continue to be, paid your coupons, or you continue to see sort of progress on board diversity, for example, then this is, actual, KPI quantitative stats that you can show to your stakeholders, and I think that's quite powerful. And also it can relate to the stakeholders' different goals as well. So yeah, you might be like laser focused on the energy transition, therefore reduction in carbon emissions is important to you, or any other carbon metrics you might want to use. So I think this KPI linkage is actually really powerful, and I think we can see more and more of it going forward.
Okay, thank you very much, Josh. Thank you. Time is against us. How I'd like to finish, I'd just like to get some thoughts about what you expect to see in the green bond market in, say, like the next 12 months. Say what your predictions are, what we can expect. And I know you may have actually mentioned these in some of your previous answers, but I think as an endpoint, it'd be good to sort of round up some of those ideas. So would anybody like to give me some predictions on what they expect to see them in the market in the next 12 months? Scott, thank you.
I can start. I think the growth rate of different ESG labeled bonds will be higher than green bonds themselves.
Okay.
So we'll continue to see green, but we'll also see, obviously, I know we're going to have more social bonds coming out of the EU, but I think we just talked about it, but the sustainability linked bond piece, I think, again, is going to be quite powerful and chime quite well with investors, because it's not just about emissions, it's other different ESG factors and the accountability piece. And I think we'll see the first oil and gas issue in sustainability linked bonds, and I think it's going to be quite interesting and probably quite decisive in terms of does it work, does it not work, in terms of how it will be done. But I think that's going to be this year in terms of so I think it'd be a very interesting one to watch.
Yes, if you're right, this is going to be a very interesting market in the next 12 months, Scott. I think what you said there. Okay. Does anybody else have anything to add to that in terms of what they expect to see? Josh?
I think we're just going to see continued growth.
Yeah, that's what I was going to say. The issuance.
Yeah, I mean, already, I think it was about $750 billion issuance last year. So we're in May and we're already at $500 billion. So I think we can take it as read that the market continues to grow.
Yeah.
And I think we can take it as read that the market will continue to wrestle with the problems and the opportunities that we'll be discussing. So yeah, I mean, I think it's definitely a market that's here to stay. I'm not sure really that in 5 years' time we won't have a green bond market. So yeah, I think a lot more of the same and in bigger volume.
Okay.
Would you not expect also there to be a rush towards issuance if people are concerned about about inflation? I mean, I know the Fed have said they're not going to raise rates, but yields are so low, they're never going to get cheaper financing. So I'm sure that's going to encourage a lot of companies to issue more debt. And if they have to do it by labelling themselves as green or sustainable or blue, that's probably how they'll do it.
Yeah, but maybe, but I think actually because of the central bank's response globally to the pandemic last year, we've had a big rush last year of corporate issuance, and actually I think this year there's a little bit less pressure for corporates to issue actually, just because they've done a lot of their funding. So I think maybe what might happen is that you might find more companies who maybe couldn't traditionally issue corporate bonds, maybe issuing some green bonds. That could, maybe I could see that happening. Although I do think that investors, we have to remember that we're well, I know you do know this, but we're custodians of our asset holders' money, and we have to make sure there's a return and et cetera, et cetera. And I think one of the things that we have to be cognizant of as fixed income investors is that we don't get sucked into taking equity risk with fixed income money just because it proves an impact. Now, I'm not saying that happens, but I think as custodians, we have to be careful that in the sort of green bond, social bond world, that is a slight risk. But yeah, more of the same, I think.
I'd agree with all the points that have been made so far. I suppose one trend that might be worth watching is, given the political and regulatory changes, that this sort of sleeping giant of the US waking up to this market essentially, and maybe wrestling a bit more. Either it'd be interesting to see whether it wrestles more parity with the EU in terms of where it wants to be as a leader in this space, or whether there's still a digging in of some of the slightly more conservative opinions in that part of the market against some of this. Would be quite interesting.
Thank you, Joe. Thank you.
I can maybe just comment on that. Sorry to interrupt.
Go for it, Greg. Go for it.
We've got a US team, like I'm sure other people have, and they're already seeing issuers talking about ESG subjects, providing more information. So I think you're right. We're already seeing evidence of the US starting to move, and my suspicion is that once the US starts to move in this area, it will move very quickly. So I would concur with what you're saying, and I would actually say that we'll probably see quite a rapid move in the US now.
I would agree. We launched our green bond fund focused. It's a global green bond fund, but focused on the European investor base through UCITS structure. But we've had our client base is fairly US centric. We've had much more interest from the US than we thought we would at this stage, which we found interesting. But that's our outlook: more growth in the green bond market, more diversification, and the US is a market to watch from the issuer perspective, obviously driven by investors as well.
Okay, thank you. Thank you very much, Sarah. Okay, guys, I'd like to thank you all for sharing your views with us today. It's good to have some differing opinions on some areas of the green bond market. I'd also like to thank our sponsors, 24 Asset Management, Mondrian Investment Partners, and Newton Investment Management. Thank you and goodbye.